What is going on, investors? Back again, another stock analysis. This time, we're actually doing a little bit of a sector analysis. We're going to take a look at three banks that reported earnings this morning. So we got JPMorgan, Wells Fargo, and Citigroup as well. And so this is recording this just before the close. So these numbers might jump around, might change when you actually see this video. But Citigroup sold off a fair amount. Wells Fargo sold off quite a bit, almost 5% here. JP Morgan's financials actually held up a little bit better. They've got some trading revenue as well. What we're going to do is we're going to jump just briefly into this, and I'll give you some broader perspective of what we're seeing here in the bank. So I've got JP Morgan, Wells Fargo, and Citigroup's financials here. Now, what we're going to take a look at first is this top line number. And as you know, we've got a big health situation here in the United States and around the world that is impacting everybody, but particularly the banks as well. We see here, they are giving you kind of a year-over-year view here. This is 2Q of a year ago. This is just the previous quarter. So you're seeing their revenue at JP Morgan's actually holding up pretty well. It's probably some of this is like trading revenue and stuff like that, maybe mergers and acquisition revenue. JP Morgan is a really, really big bank, as all these banks are, but JP Morgan's got a little bit more diversified in some other things. Non-interest expense here, we see holding steady. You like to see that, but the key thing you are looking for when you're analyzing the banks right now is this provisions for credit losses, because this is not only going to give you indication on what's going on at this bank, but it might give you an indication on what's going on with the consumer and what might happen going forward in all kinds of consumer credit things, house prices, consumer spending. Take a look at this, guys. Q2 2019, notice they had about, I'll call it $1.15 billion in provisions for credit losses. This is what they're expecting to lose on credit cards and other kind of loans. Take a look at where it went in Q1 of this year, all the way up to 8.2. And now look where it is. It is nearly tenfold where it was a year ago. Their provisions for credit losses at $10 billion. Guys, before I go any further, please don't ruin your credit. Do whatever you can over the next few months. I know it's hard for everybody. People are losing their jobs. You're losing your income. Do whatever you can to maintain your credit, because when we come out on the other side of this, the way you're going to get wealthy is by actually accessing a lot of this credit, not necessarily through a credit card, but maybe through some kind of loan or a mortgage or building up a real estate empire. If you ruin your credit over the next few months, you are going to be behind the eight ball. And anybody, if you're watching this and you're taking care of your credit, if you're driving it up, you're getting your credit score up, things are going to be really, really good, I think, financially for you headed into next year. So get your credit up. Please take this as a warning sign, but also investors out there, look at this. They're really increasing these provisions for loan losses. Now, earnings per share, everything else looks pretty fine here. You can see why JP Morgan hung on pretty well, but this number right here, not necessarily negative so much for JP Morgan, but it's just showing you the consumer out there. They've got all kinds of experts and algorithms and all this stuff that project this kind of things. And if this is what they're projecting to lose, and it's been going up, you see quarter over quarter, it went up, and it obviously is up basically tenfold from the previous year. That is not good. Let's see what's going on at Wells Fargo. Again, their stock sold off quite a bit more. And actually, if you look at Wells Fargo stock here from a book value perspective, I don't know if this is right up to date with the most recent earnings, but look at this. Historically, this is a company's book value going back 7 years here, traded in this price to book and call it 1.2 to 1.5 range, and is now trading south of a 1 to book ratio. So this is a company from a valuation perspective looks kind of cheap, but you see here revenue. So we've got June 30th here. This is the previous year. This is the most current quarter. So we can see revenues really slid off a cliff here. And they actually slid off pretty nicely from the month before. They've got, just like JP Morgan, provisions for loan losses. Look where they were a year ago, 480 million. Now look where they are. And even quarter over quarter, this is accelerating. That almost doubled provisions for credit losses. That is telling me that these banks are predicting lots of defaults on credit cards, defaults on mortgages, defaults, businesses defaulting on loans. All that type of stuff is happening, and that should be scary for you as maybe a shareholder, but it also will create opportunity. Like I said, if you keep your credit intact, and in fact, I think you should use the rest of 2020 to improve your credit, get as close to whatever the perfect score is, like 800 as possible, you are going to be in great shape, because look at all these people these people are not going to be able to get a mortgage. They're not going to be able to get a good line of credit. They're not going to be able to get home equity line of credit. They are not going to be able to borrow money because these banks are going to tighten their lending because of this. Okay. They're starting to see more losses. So they're only going to start loaning, and they're already doing this, and it's going to get even tighter. So if you have great credit, you're going to get access to it, and you're going to be able to scoop houses that are going to go down in value. You're going to be able to start a business when all these other businesses close. It's just showing me this is a great opportunity. Obviously, I'm not here celebrate. I get some comments saying, hey, I'm celebrating houses going down. I'm celebrating people struggling. That's not what we're doing here. This is an investor channel, and we're looking at it from that perspective. Obviously, we're praying for everybody, and we hope the best for everybody. Now, Citigroup here, a little bit different way they present these financials. So we've got 2019 over 2020 here. And we've got quarter over quarter here. And now, everything looks fine here. Their revenue is going to go down a little bit. And from a revenue perspective, here we are. It's flat. And I think you can, this is better than, some of the other companies we've been looking at, like Bed Bath & Beyond and Levi's and Carnival Cruise, where their revenues fell off a cliff. But here's expenses. And we've got credit losses here. Those are climbing, but here's our net. They call it net AC build. So this is what they're building. This is their provisions. Look where it was in Q2 19. It was 111, call this million. Yes. Then it went all the way up to 4.8 billion, call it 4.9 billion. And now we're up again to 5.6 billion. Citigroup is also provisioning lots of money for lots of defaults out there. Now, how do you play this? So if you want to analyze any of these companies, just look at it from a price to book. Go look up price to book. I could do it here on the channel, but for the sake of this video, I'm trying to keep it short. Just look up the book value per share. But these companies, if they're provisioning lots of losses like that, they're not going to be able to loan out as much money going forward. I think credit scores are going to drop for the average people. They're going to have to be careful issuing credit cards and loans, especially to businesses and mortgages. So book value might continue to slip over the next few quarters and months ahead. Now, Citigroup, this is a stock that I do own, much lower than this. I bought this group a while back. Same with Wells Fargo. Bought this a while back, although I'm probably about break even here. JPMorgan's a new addition to my portfolio. I think I'm still in for a little bit higher price than it is here. But if you want to play this sector, I think you want to, unless you're really good at picking stocks or you want to build the portfolio out yourself, the XLF ETF is really what most people do. And as you can see, this is reacting very similar to these stocks. It's sold off and it's pretty much been kind of in this sideways motion. And I think that's where this sector is going to stay. They're not going to be able to increase dividends. They're not going to be able to do buybacks. They're going to have to keep increasing loan reserves. They're not going to be able to lend as aggressively because they're going to have lots of people with poor credit and reduced credit over the next couple months. So this is going to be a sector that's going to trade sideways. But I think at some point you start seeing some upside here. You're not going to see rapid moves to the upside in this sector. You will collect a small dividend. And I think that's really what you're buying this sector for. You're getting a little bit of a value when you analyze it from a book value perspective. You're probably getting these on, look at this 5-year average, 1.38. You're getting it about half off. In terms of Wells, this is just Wells Fargo. Citigroup, I'm sure, is trading at a well-reduced book value. JPMorgan, probably not quite as much. You're probably paying up for that. But from the financial sector, you're getting it for a reasonable price in terms of historical average. You're going to collect a reasonable dividend, and I think you'll have reasonable growth going forward. But that growth is probably, I would guess, at least 12 months out before you start seeing some real growth in this sector, because they are going to be under pressure. So we've got more bank earnings and more releases to come, but what I would look for is this provision for credit losses on all of them and see how rapidly it accelerates. That is not going to be good for these banks. And it's definitely not a good sign of the consumer and the health of the consumer going forward. So I would definitely be positioning, if you're an investor out there, position yourself. The rest of 2020 for me is positioning yourself for 2021. Get your credit as high as possible, get some cash, start figuring out how you want to invest yourself in 2021. Do you want to start a real estate portfolio? Do you want to get more into stocks? What do you want to do? And it's going to be different for everybody out there, but there's going to be tons and tons of opportunities going forward when you're going to have all these people just literally wreck their credit in one of the best times of all time to borrow money at low interest rates. There's going to be lots of easy money, not right now, not in the next 6 months, but probably 12 months from now, you're going to be able to easily get loans and mortgages and things like that if you have a high credit score. And that's what I am looking at when I see these loan reserves. And finally, from a stock perspective, unless you're really coming in here and picking these, I would play the ETF, but I don't think you've got any rush into this. Okay, the banking sector is going to be sideways. The Fed has these guys by the neck, and they're not going to let them raise dividends or do buybacks or anything like that. And we've got an election coming up, and I think if one side happens to win, they're going to be a little bit, at least on rhetoric, they're going to be a little bit harder on some of the financials. Although, if you look at the state where the current frontrunner is running from, he will be friendly to the banks, but I think his rhetoric will be tough. So that could provide some more buying opportunities going forward. So I wouldn't really run into this. So hopefully that helped you guys out. Really quick video getting this out to you. Leave me a comment below if you've got any comments, if you got any stocks that you'd like for me to cover. Expect a video almost every day for the next, I would say next month on this channel. Hit that subscribe button if you want to be a part of it, and that like button as well. Thank you for everybody that has been watching and commenting. The channel has grown exponentially over the last few months, and I have all of you to thank for that. We'll be back again. Good luck with your investments.